Okay, let's get into it. Thank you very much. Welcome to our webinar. As I say, our topic today is investing correctly, and so we're talking about a bit of behavioral finance. Just a show of hands. How many of you believe that you're investing correctly? Hey, there's a little facility in the box where you can put up your hands and things like that. Okay, quite a few of you think that you're investing correctly. A bit of a trick question, I know. But okay, you can put your hands down now. Thank you very much for participating. Yeah, a lot of question marks. So, yeah, as I say, it is a trick question. Okay, great, awesome. Okay, lot of question marks. Okay, no worry, that's what we're going to discuss in the webinar. Cool. Okay, so in behavioral finance, we learned that there are many investors that have bad investment habits. Okay, because their brain helps them to lose money by leading them on the wrong path. That's basically what we're going to talk about today, some of those attributes. In this webinar, we discuss how to benefit by being a disciplined investor. That's my whole gist today. So after the webinar, I hope the results for you to achieve is, first of all, to create awareness. You can do something about your bad habits, for example, and you can plan better. And number two, to provide options so you can make better informed investment decisions and ultimately have peace of mind. Okay, so let's kick it off with a quote. And the quote, let me just get it to the next page. Quote says, when money realizes that it's in good hands, it wants to stay and multiply in those hands. So I just hope I can pronounce the author. The author is Adawu Kayanakan. He's the author of a book called Wealth for All, Living a Life of Success at the Edge of Your Ability. Okay, so that's where I got the quote from. So let's look at why we have this situation. The current situation for many investors, okay, and that's where I'm coming back to our main topic, are you investing correctly? Gambling is exciting and can be fun, okay? Some of us like to gamble. Gambling is entertaining. Gambling can make you rich, or so you imagine, but the odds are against you. Okay, last night I saw that there was a Powerball of something like 70 million or something like that. Quite a few people would have played it. But as you might realize, the odds are against you. Something like 1 in 146 million chances, something like that. But the odds are seriously against you. Okay, but that's why it's called gambling. Okay, that is why casinos are such profitable businesses. But saying that, investing is not gambling. Okay? Investing is supposed to be boring. I once saw a quote, I think it was from Warren Buffett. It says it's like watching paint dry. Okay. So investing is supposed to take a long time. Investing is not supposed to be fun. However, if investing is done correctly or properly, it can make you rich. Okay. It might just take you a bit longer, but also with a bit of luck. So any successful investor will tell you, now this is what I found interesting. Any successful investor will tell you that the investment profits are not made in the buying and the selling. They're made in the waiting for the investment to prove itself. Now I thought that was a pearl of wisdom there. Okay, so the current situation, as I say, for a lot of people is, and this was also when I was doing my research, I found this was also quite interesting. In recent years, investors have shown their inability to hold on to investments. Did you know in 1960, the average holding period for stocks was around 8 years? And guess what? As of 2010, the average holding period was around 6 months. Okay, now I was amazed at that. And now you might say, wow, does that apply to South Africa? These are global stats. And in other words, it affects many markets. So the point I'm trying to make here, short-term investing or gambling shows up in investor performance. In other words, individual investors, they need help. So I said this is more of a global stats thing. Years ago, when I first got involved in trading and investing in the market, from an education point of view, that I knew that in the States, as 50% private investors and 50% institutional, because obviously the whole capitalistic culture and things like that. So people are more involved in the markets directly. Here in South Africa, over the years, I realized that's 10% direct investment and 90% institution. When I say institutional, it's a pension fund managers and that kind of stuff. It's a lot to do with financial education. Okay, so it was quite interesting to notice that the holding period has dropped drastically. Imagine what happens here in South Africa. So that's the current situation. So if I bring it into visual terms, visual share portfolios are underperforming. There's losses. There's a lot of indecision, especially with the volatility and uncertainty around at the moment. So it's leading to panic and fear. A lot of people are saying, are we still in the bull market? Are we in the bear market? So are people moving? Are they moving out of cash? Are they moving out of, into the money market? And ultimately, this is what leads to a situation where many people do not have enough savings for retirement. Okay, so what is the ideal situation? So, and this comes back to what I was talking about right in the beginning about behavioral finance. Okay, now according to conventional financial theory, the world and its participants are, that for the most part, and this is where in quotes I can say, rational wealth maximizers. What does that mean? It's a rudimentary assumption that most of us are seeking to increase our own well-being. So that's when I was talking about rational wealth maximizers. However, there are many instances where emotions and psychology influence our decisions, and I think this is where we are emotional. You know, we talk about greed and fear being the biggest enemy in the share market, and that is so true. So this is what causes us to behave in unpredictable and irrational ways. So behavioral finance is a relatively new field that seeks to combine, on the one hand, behavioral and cognitive. In other words, this is the process that we learn to gain knowledge, but also cognitive psychological theory. In other words, we're looking at our attention span, our language use, our memory perception, and all those kind of things together. In other words, how do we think and feel as investors? But that's combined with conventional economics and finance, and that provides explanations for why people make irrational financial decisions. So in a nutshell, that was behavioral finance looks at. So when we start using labels like conventional or modern to describe finance, we are talking about the type of finance that is based on rational and logical theories. Now, those of you that have studied finance and things like that, you've heard of capital asset pricing model on the one hand, and also the efficient market hypothesis. Now, me being a technical analyst, I know more about the efficient market hypothesis. But those of you that don't know what the capital asset pricing model means, all it is, it's a model that describes the relationship between risk expectation and risk and obviously expectations, the expected return. And that is used in pricing a risky security. So bottom line, investors using that model want to be compensated in two ways. Number one is the time value of money, and number two, risk. Okay. So I haven't really dealt with that model before, but I have dealt with what they call efficient market hypothesis. Now, this is highly controversial and often very much disputed. Me being a technical analyst, I will dispute this. What it means is that the believers believe that it's impossible to beat the market. Okay, market efficiency causes existing share prices to always incorporate or reflect relevant information. So whatever's happening in the market, it's reflected in the share price. That's their belief, number one. And the main thing is, these guys believe that stocks will always trade at fair value. Now, those of you who know that Warren Buffett is a value investor. He buys undervalued stocks, and that's how he outperforms the market. So the believers, there's two things they're saying. Number one is that there's no such thing as undervalued stocks. Obviously, they throw out fundamental analysis. And secondly, they say it's impossible to predict trends, and that throws out a technical analysis. They believe that the only way to outperform the market is to purchase riskier investments. So, as I say, I hope you got the idea that I don't believe in this efficient market hypothesis. But that's what we're talking about when we talk about conventional economics and finance. So, as a kickoff to get started into more into the gist of the presentation, there are 4 ways to check whether you are investing correctly. So, number one, do you have Warren Buffett's mindset? What do I mean by that? One of Warren Buffett's criteria for buying a company is that if the stock market had closed for 10 years without the ability of you selling the share, his philosophy was he would still be happy owning those shares for those 10 years. Now, the question for you is, okay, that's exactly how you should consider your investments. do you consider your investments like that? If you can't be able to sell your shares for the next 10 years, would you still be happy holding that share in your portfolio? Secondly, okay, what is the best way to invest? And I've done this quite a few times. You think like a business owner. I always say, don't be a shareholder. Think yourself as a part owner in a business. What do I mean by that? So imagine that you're looking at investing in a franchise, or you're looking at buying into an existing business. Hopefully you do your due diligence. In other words, you assume that you'll be making investment in the company and you'll be doing your homework. Okay. The problem with this is if you buy into a franchise or into a business like that, the drawback is your investment that you can't really get your money out straight away. It's going to take you a few years, or you have to be bought out, whatever the case might be. In other words, the funds is illiquid. Holding your money into a private company like that is illiquid. So you need to make good choices where you decide to invest your money. On the other side of the coin, obviously JSE listed shares, okay, yeah, you can trade 5 days. The JSE is open 5 days a week, and you can trade multiple times within those 5 days. Okay, although this is a luxury, this might not be so prudent. Okay, way to invest, buying and selling. Okay, especially if you're looking at being so active. So many people don't even hesitate of buying, selling the shares very, very quickly. So if you had to take the view that for each investment in your portfolio, you had to have a 5 to 10 year view, your approach to the market will be totally different. That's the point I'm trying to make here, as by being a business owner. You got to do your homework much better. And the choices, okay, where you're going to put your money would also change very substantially. In other words, instead of buying companies that are, for example, have negative earnings, they're loss-making, you won't be putting your money to those kind of businesses. So you'll have a total different mix of investors getting involved in the market. Okay, so I hope that makes sense to you guys when I mean by being a business owner. If you had to do a physical due diligence on the company, you'll be a totally different approach to the market. The third point here is, do you use compounding to compete with the smartest investors? Now, what I mean by that, okay, when you're investing in the share market, you are competing with the institutional investors, as I mentioned just now, the fund managers and the pension fund guys, the big guys, okay? Now, many of the big institutions have, for example, 8-figure budgets, and they use that for research and technology, and that will dwarf you as an investor and will put you at a disadvantage. Okay, but what are the equalizing factors that you can use as a private investor is to use compounding over time. What do I mean by that? If you invest in a company which is growing at a rate of 10% per year, then you can reasonably expect a 10% annual return over a period of time. So again, I'm harping about being a long-term investor. You need to wait years, not months, for this investment to grow. I'm going to bring in Warren Buffett again. Warren Buffett characterizes his investment timeline as forever savings, forever investment. Although he does make changes to his investment portfolio when the share doesn't meet his criteria. So yes, it's not so fixed. What I found interesting with Warren Buffett, he allows his investment to compound over time to where his original investment in the company is approximately equal to what he receives in dividends each year. Now, that's a way to look at the market. Okay, so interesting way of looking at it. And the fourth point I want to look at is, if you're looking at ways to check if you're investing correctly, is, are you investing for the long term? Yes, I'm harping on this idea, but holding a share for 10 years versus 10 months will maximize the impact of tax on your investment. So that's one of the things you also have to consider. If you have done your research properly, okay, it will allow the investment to prove itself in a tax efficient manner. And this is not to say that every investment should be held for 10 years. If the shares are dog and there's no growth prospects, cut your losses. Okay. The point I'm trying to make here, what is important is investors should remove the gambling mindset from your thinking. Okay. So I hope that makes sense to you guys. So how do we get there as a better investor? So remember, investing is a process of constantly taking information and using that information to build what they call simple mathematics as grounding for our deals. Okay, we're looking at investments that meet a number of fundamental criteria and focus on underperformance in the long periods of time. So the JSE, remember, is operating in very, very short time periods. We saw recently with the whole Brexit thing, people are fickle. People are fickle. They pull out their money out of their market very, very quickly, and they fire their financial advisors because of the bad year, whatever the case might be. As I mentioned just now, successful long-term investors do not speculate on what the government or what's happening with interest rates or what's happening with the economy, which way it's going. Okay, what you want to do, you want to be patient, and you want to be gaining knowledge, expanding your knowledge all the time, and you want to be studying. And I mention this all the time, that you want to be a constant learner of the market. So that's what I'm talking about today. So what I'm proposing now, there's two ways of looking at it. You can go the direct route, or you can do it indirectly. Over the years, I've been involved in stock market education since 1988. I've learned that, to become successful in the market, to achieve financial independence or financial freedom, there's a process. So yes, as I mentioned now, it's gaining that knowledge, gaining the skills, having the time to be watching the market, but also the ability to stomach risk. And a lot of people don't have that. They panic very, very quickly. Okay, so it's a lack of discipline. And I always say, as a trader, my goal is to be a consistently profitable trader. But even as an investor, you want to be consistently profitable. So it's overconfidence a lot of times that leads people into problems. Okay, so that's, if you want to do it yourself, that's what you need. Okay, and it's never ever stops. I've been involved, I read books all the time, and I'm researching and I'm studying all the time. So that's the direct approach. Many of you, and I've seen over the years, will be more the indirect approach. And yeah, we're talking about the advantages of indirect investment over direct. When I say direct, it's directly into shares. So first of all, investing into unit trust offers you diversification. If you had to compare, you're holding on average between 20 and 30 shares in your unit trust. You have little danger of one rotten apple spoiling the whole portfolio. So that's one advantage. Number two, you're getting professional portfolio management. Now, there's a great difference between being a part-time stock picker and being a full-time fund manager. Okay, so that professional portfolio management, and I highlighted again just now, comes to the fore. And the third thing is you have a lower entry-level amount. We always say to people, there's no minimum amount to invest in shares. You can start with 1,000 Rand. Our minimum brokerage at PSG Wealth is 0.9%, but it's a sliding scale with a minimum of 98 Rand per trade. So to do it properly, I suggest 10,000 plus. Then your cost drops down to down to 1%. So, for example, if you go buy two quality stocks, 20,000 Rand. A lump sum in unit trust, the same thing with 20,000 Rand will give you a portfolio between 20 and 30 stocks. That's what I mean by that scenario. And also, talking about that, it leads onto costs, the economies of scale. The fund manager can buy and sell more frequently, so the costs are much lower, and obviously that provides higher performance and returns to investors. So those are just some advantages. What am I proposing today? Now, as I say, you can go the route of direct investment, buying shares, or you can go into unit trusts. I'm suggesting go one step further. Instead of looking at unit trust, which is an easy access, and this is the problem where a lot of people have easy access to a thing, they'll be able to sell. Okay, I suggest that you use a wrapper called endowments. Okay, and this helps towards what we call disciplined savings. So the PSG endowment is a type of investment product. It's a long-term saving vehicle. When I say long-term, we're talking about 5 years in this example. But gives you access to your money. As I say, there is a restriction period. We talk about the restriction period just now. What's advantage here is this is ideal for someone that's paying more than 30% in personal tax. Okay, so that's what you're looking for. It's someone that's paying more than, this is ideal for someone that's got in a higher tax bracket, paying more than 30%. So what are the tax benefits? Now, as a natural person, remember you got a marginal tax rate between 18 and 41%. They increased the Capital gains now, the inclusion rate is up to 40%. So 40% of 41, the effective tax rate is 16.4%. That's as a natural person. You're still paying 15% dividend withholding tax. Interest, depends on your tax rate, between 23,800 and 34,500. That's interest to be exempted. And then also your first 40,000 of capital gains is exempted or excluded. Okay. Now that's if you had to buy into unit trusts. Within a endowment fund, the maximum effective tax rate drops to 12%. Okay. As I say, ideally for someone earning more than 30%. So there's no benefit to you if you earn less than, if your marginal tax rate is less than 30%. So these are for people earning more than 30%. This is an ideal vehicle for you. So let's look at a little bit of a case study. If you had to go the unit trust route, you can say it's even a share portfolio. But let's have example, you started off with a R1,000,000 share portfolio, and after 3 years, or 5 years rather, your portfolio has grown with capital gains of 2 million. In other words, your portfolio value is 3 million, but you make 2 million rand in capital gains. In the unit trust investment, the capital gains payable, remember you got 2 million profit. Individual will be paying 16.4%. How did I get that? That's 40 times the 41% marginal tax rate. That's 16%. So that would have been 328,000 Rand in tax you would have paid. So your net investment after tax would have been 2,672 Rand. Same scenario, same shares, but if it was wrapped up in an endowment, remember the tax rate is much lower. So we're talking about 12%. So you only pay 240,000 Rand in tax. So that difference doesn't sound a lot. Okay, it's 4.8%. But that 4.8% is equivalent to 88,000 Rand. Okay, so that's a big difference. So let's talk about more about, we're talking about an investment period just now. So here we got a scenario. In year 1, so remember the initial restriction period is 5 years. But during this time, you can access your investment, but your access is limited. And I'll explain that in more detail now. You can access your investment at any time after that restriction period, that 5-year period. So in year 1, this comes back to the scenario where obviously it depends on how much you want to invest, but during your first year, you can make unlimited ad hoc contributions. That's number 1. And number 2, in other words, there's no restrictions on the top-ups in your first year. So in my example here, I invested 200,000 Rand in my first year. In my second year, I put in 100,000. In my third year, how much can I invest? And now this is where it gets a bit more trickier. We talk about this 120% rule. So the 120% rule works like this. It's let me get my notes here quickly. There we go. After the second year, your contributions may not be more than 120% of the highest contributions made in the previous 2 years. So in the previous 2 years, my highest contribution was 200,000. So that's 120% of that. So that's how I got to that 240. Okay. So anyway, after 3 years, I decided I need that money. I want to put a deposit on my house. Okay. Now you got 2 scenarios. I can withdraw that full amount. Okay. Remember, that's my contributions. Plus, okay, 5% if there was any growth, 5% of the growth. And that's a one-time withdrawal. Obviously, on the growth, you'd be paying that tax I was talking about just now, less than 40,000 Rand. Another scenario is you can have a loan up to 80% of the value. So in this scenario, 432,000 Rand I can take out. Remember, it's a loan, so it's tax-free. Okay, so a nice way to save. After year 5, I can withdraw unlimited. So I hope that makes sense to you guys. Remember, this presentation will be sent to you, so be able to go through it in more detail. Any questions you have, you're welcome to drop us an email. So what are the benefits? What will this do for you? So first of all, the endowments enables you, as I said right in the beginning, you want to have access, so freely access to your funds. So that's one form of disciplined savings. Number 2, tax efficient. It pays any applicable tax on your behalf. Within the fund, it pays the tax. Okay. So it's ideal, as I said, for people paying a higher tax, more than 30%. And also, thirdly, the ideal benefit here is for estate planning. You can structure your estate in a more efficient manner. Remember, we don't pay any executive fees. That's at 3.9. I think it's 3.9%, if I remember rightly. 3.9%, and the other side of the coin, obviously, the estate tax will still has to be paid, but that's in the hands of the beneficiaries. What's nice about it is obviously I can have beneficiary nomination, so it's up to the beneficiaries, your chore, to decide what to do with the funds and things like that. So anyway, nice way of looking at investing. What are the benefits? You have access to a wide range of investment funds. There's more than 400 unit trust funds to choose from that we've gone through, and obviously you can switch between those funds at a very low cost. Okay. The contributions, as I say, you can make regular contributions. I'll talk about in the next slide. What are those contributions? You can either make it by debit order or lump sum, and obviously a combination of them. It also gives you flexibility. You find you're running into some financial difficulty, you can suspend your monthly contributions, your debit orders. But the idea is that you're trying to resume making contributions as soon as possible. So you might have some additional questions. I've anticipated your questions. What are those contributions I mentioned just now? Lump sum, the minimum requirement there is 20,000, and obviously you can make additional anything above that. Or you can also use debit orders, and the minimum there on a monthly basis is 500 Rand. Okay, or a combination of the two. Just remember that 120% rule applies in your third year. Okay. Can you lose money? And the answer is yes, because the value of your investment is linked to the underlying instruments, which is obviously the market. So there's no guarantees. Okay. It's important that you ensure that you are comfortable with the level of risk. Okay. The other thing is about endowments. It's not like a retirement annuity that you're protected from your creditors and things like that. This is what we talk about being a compulsory investment. That's RAs, and we talk about voluntary investment. These are unit trust and endowments. So you're not protected against the claims from your creditors or from your ex-spouse when you get divorced. Okay. So those are some of the things you might have considered. So what kind of questions you guys have? Let's see what kind of questions you guys have typed up here. Okay. 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 I love just reading the previous answers to my question right in the beginning. Not sure, not sure. As I said, it was a bit of a trick question. Tony, great. Yeah, work on your mindset. Appreciate that. Okay. Rakesh, remember Rakesh is asking the question here. In your endowment scenario, you're paying the capital gains tax up front, whereas in the unit trust, you can defer the tax until you sell over the 20 or 20 years. That's not comparing it together. The idea is if I'm taking my money out of the market, that's when I trigger that event. Okay. So you must compare apples with apples. But remember, within an endowment, the capital gains is taxed within the endowment at a much, much lower rate. Okay, that's my point I'm trying to make here. Okay. Benjamin, yeah, we'll try. Benjamin says, I'm a millionaire. Can you make me a billionaire? Okay. Guys, look like that's all the questions. None. Okay. Nikita, no problem. Okay. Awesome, guys. Looks like all the questions. So, Rakesh, I hope that answers your question. Okay. Okay, let's wrap this up. In conclusion, what I want you to remember from this presentation, endowments are tax-efficient investment vehicles. Secondly, obviously, from a tax estate planning point of view, it continues into perpetuity. And also remember that flexibility. You've got more than 400 funds to choose from. Okay, so what are your next steps? Where do you go from here? So I suggest if you haven't got an endowment policy, if you do, maybe consider topping up. But there's a link to a PSG Wealth's endowment investment, so you can learn about it. As I say, the PDF and the recording will be sent out today. And if I can really appreciate you or ask you to complete the Survey Monkey, it gives me a lot of feedback regarding my presentation. Okay, any queries? You can also contact our client services department There's the contact details. Guys, from my side, thank you very, very much for participating. Just want to highlight for you guys upcoming events. Tomorrow night at the JSC, I'm actually involved with the JSC Power Hour tomorrow night. So you can either attend it if you're around the country, there's a webinar option, or if you're in Joburg, you're welcome to come to attend the JSC function at the JSC. It's from 5:30 to 6:30. And as I say, it will be on webinar too. But please go into our website. You can register for the event on our website. That's number one. Next week, Wednesday, we're talking about are you tax-free? The Wednesday after that is the municipal election, so there won't be a webinar. On the 10th of August, we're talking about 5 bankers not affected by volatility. When I say bankers, it's a horse racing term where you talk about a sure bet. So there we're talking about fundamental analysis. The week after, we're talking about technical analysis. And then we're talking about a locally diversified investment strategy at the end of August. And yeah, those are the webinars coming up. So you guys can go onto our website. You can click on this little link here, webinars, will take you to the page and you can register. So guys, thanks from my side. Thank you very much for being on this webinar. Until next week, all the best. Bye for now.